Good afternoon. My name is Thomas Seneca, founding partner of TM Wealth Management, and I'm joined today with Matt Hartson, our Chief Investment Officer. We're excited to share with you today our Is Your Portfolio Personalized for You webinar. We'll give it another couple of minutes for folks to kind of chime in and everybody to get situated. So we'll kind of mute for just a minute and get started here as we let other folks kind of jump in. Great. Well, again, let's go ahead and get started. Just a little bit of housekeeping for everyone. This is what we're presenting here is for educational purposes, right? Give you some information, general ideas here, and then we encourage you to meet with us or your professionals to really figure out how these concepts and principles apply to your specific financial situation. A little bit of background on me. Just started my career on Wall Street working for Goldman Sachs and Deutsche Bank, and founded TM Wealth Management now a little over 10 years ago, and excited to be able to share this information with you today as well. And just a little kind of snapshot about TM Wealth Management. We structured this to be independent. Our firm, we don't have any shareholders, we don't have a home office. We really work for our clients. Additionally, really wanted to keep it boutique. As I mentioned before, I started my career working with large investment banks, and obviously they have their place and a lot of good things to say about both of those institutions. But for me, in structuring TM Wealth Management, I wanted to make sure that we were doing things that were boutique, so we could work individually with each client and go deep with them. Additionally, wealth management was important to us, really focusing not just on portfolio and stocks and bonds, but the whole financial picture, looking at things like estate planning, tax planning, financial planning, investments, insurance, all of those things to make sure that we can provide the best service for our clients. And then the way in which we're regulated, right? We chose to be a registered investment advisor, which really puts us under the SEC's fiduciary rule, which is we have a legal responsibility to do what's in best interest of our clients. So a little commercial about us, a little snapshot. So just a little bit of background and insights on me. I've got 4 other siblings, 2 older brothers, and I always got the hand-me-down clothes. So this is kind of the suits that I would get never fit. And so as I got my first job, I went off and got myself an off-the-rack suit, and it was way better than what I had before. But then as kind of my career went on and really started looking at kind of tailored suits, and you really start to see and feel the difference between an off-the-rack suit and a tailored suit, right? You think about off-the-rack, these designers are trying to build something for the average person. And when you get a tailored suit, it's specifically fit for you. And so when you think about the benefits of a tailored suit, right, it fits better, it meets your design, customized to you, and that gives you kind of greater confidence, better comfort, and lasts longer. And as we think about how some of these principles might apply to portfolio construction, Matt, what are the benefits in your mind of portfolios that are kind of customized to the individual's needs?
I think the first one is it meets those individual needs that you just talked about there, Thomas. Maybe it's a client who needs additional income, and they've got income available in a more tax advantaged way, depending on maybe what the state of residence is, those sorts of things, or maybe it's someone who thinks about socially responsible investing and wants to have their portfolio invested in the types of companies that work for them. All of those things, very handsome as you move there across your tailored suits there. It's really just about fit and making sure the portfolio is optimally structured to deliver the best outcomes, whether that's on a return basis or controlling risk for a particular client.
Yeah, man, I really like that word optimal, right? I mean, you think about, as we kind of relate this to a customized suit, right? They're both very functional, right? They both work, but the optimal outcome, the optimal look optimizing your portfolio for your specific needs and benefits. Historically, the traditional approach to portfolio construction was, hey, let's do a 60-40, a certain percentage of stocks, a certain percentage of bonds, and get the return from the market. In our view, that's kind of like building a house or building a portfolio with one tool, like a hammer. What we want to do as we build portfolios is take the entire investment universe and utilize that to help us accomplish the outcomes, right? So that's kind of having this entire toolbox of investment options available to us to optimize, as you use that word, Matt, to optimize the outcomes and the fit for each individual client. And talk a little bit, Matt, kind of this idea, help us understand a little more around what are these non-traditional or alternative assets that are highlighted here in the slide.
Yeah, and I don't necessarily like that word alternative or non-traditional because I think they're becoming far more mainstream at this point. You think about something like you're listing here in the middle, private equity. That's simply making investments in companies that haven't gone public yet. Well, if you look at the universe today, there was something out from Apollo that they came out with that 81% of the firms out there with revenues over 100 million are private companies. And so it's just a different set of opportunities, a different set of companies you can invest in, lend money to, different ways to invest. I think we're going to see that word alternative sort of move out of the mainstream as this becomes more of an ability to customize, to use the same term again, to optimize a portfolio that has the ability to deliver more specific return and income requirements for a specific individual.
Yeah, I think you're right, Matt. And what do you think it is that has made these maybe not alternative or not non-traditional? What are the dynamics that have occurred over the last decade that have made these more, I don't know if it's accessible or more prominent as a diversification tool?
Yeah, I think what it is really this democratization of access. I started my career running large endowments. And so when I was managing endowment for the state of Idaho, I had about $1 billion I was working with. I had the ability, that's 20 plus years ago, to access all these different types of investments, but that hasn't been available to the individual investor at lower investment levels really until the last, I would say, 5 to 10 years, where they've developed vehicles that allow individual investors to have this access. And they've made these vehicles much more user friendly. So instead of the traditional limited partnership investment where you had to be prepared for capital calls at any point in time, where they could call you up and say, we need X% of your investment tomorrow, they've developed a number of what are called evergreen vehicles that allow you to make a specific investment at a specific time and then not have to have those capital calls coming at random times into the future. And so I think the investment firms that have really focused on how can we provide these same opportunity sets to individual investors have really made this something that's now accessible across the board. There are still certain accreditation requirements and other things that need to be met. So as you said to start, you always need to talk with your advisor about what does work and fit for your specific portfolio. But to me, that's the big piece there is as the companies have expanded the offerings and expanded the format in which you can invest, now all of us have the ability to operate in these spaces and take advantage of some of the opportunities there.
Yeah, I think it's indicative. I think there's a push now to potentially get some of these types of strategies in 401k plans, right? So it really is getting to the point where I think individuals and investors need to be aware of these types of asset classes to really understand the benefits, but also some of the differences and how risk is maybe different with some of these vehicles than what they're used to with traditional stocks and bonds.
Yeah, I think that's such an important piece there is sort of focusing on the risk. When you think about traditional stocks and bonds, they're very much impacted what's going on in the economy day to day. But there are certainly some investments here in this non-traditional bucket that don't have that same impact. One of the investments I know we do for a number of clients is investing in song royalties. And we're still playing music on Spotify, regardless of whether the economy's up, down, no matter what the tariff rates are, we're probably going to pay that music. So that gives us a really nice uncorrelated income stream coming into client portfolios.
Yeah, great. And so when you start to think about why alternatives, talk a little bit more about why, some other, alternatives, non-traditional or these expanded asset classes This is a report that Morningstar puts out every year, and they look, what are the large investment houses projecting the long-term returns to be for equities and bonds? And you can see here, right, you got BlackRock, JP Morgan. JP Morgan's a little bit of the outlier, right, saying about 6.7% for the next 10 to 15 years in US equities. Research affiliates, Schwab, Vanguard, they're all putting out their estimates. And if we take the average of those two and look at a 60-40 portfolio, that gives us an annualized rate of return of about 4.8%. And so what we want to start to look at is, okay, well, at 4.8%, are there areas that we might be able to, without too much more risk, get a little bit more return for the overall portfolio? And so that's why we start to look at alternatives, not just for the non-correlated benefit. That's nice, but we also want to get some return benefit from those added investments that we incorporate into the portfolio.
Yeah, I think that's very important if we think about the last 3 years in the markets and what we've seen there. We've seen exceptional years where a 60-40 portfolio has done very, very well. But what that means is most assets are more expensive than they were 3 years ago. And as I'm sure we talk about with clients all the time, we want to look for things that are on sale. And certainly US stocks are a little expensive today. So that's why I think that return number looks low and certainly highlights the benefits of looking beyond the traditional core portfolio.
Yeah. The other reason we do is two things that you brought up, Matt. Correlation, and these slides or graphs are a little bit busy, but on this left side with U.S. stock bond correlation, what we saw is as inflation kind of went up, the correlation between stocks and bonds went up as well, and really hasn't come back down too much, even when inflation came back down. And just to give you a sense for what correlation is, it really just indicates how much two securities or two investments or two things move in relation to one another, right? So essentially, if everything goes up together in your portfolio, that also means that everything can go down together in your portfolio. So when we start to look at correlation, we want things in the portfolio that move independent of one another, so that as other things are going up, maybe some things are staying flat, and as other things are going down, other things might be going up. So really just constructing the portfolio so that it all doesn't go up and down together. And then on the right side, this is really surprising to a lot of people. They think that you always hear about the big IPOs and more companies going public and raising capital. But if you look at this over the last, 20 plus years, the number of public companies, right, back in the 2000s, it was about 7,000 public companies. And now we're down in about the $4,000 to $5,000 company range in terms of the companies that are on public exchanges that we can just go on our Schwab account and invest in. And the blue line indicates that there's significantly more private companies out there to invest in than there are kind of public and companies on exchanges. And so that's why we need to start to look beyond the traditional public equities and public debt. Anything else there, Matt, to add to those two graphics?
No, I think the one thing I'll mention that'll date me a little bit, when I started in the industry here in the early 90s, the Wilshire 5000, which for those of you who aren't familiar with that index, is just a big index of tried to track all of the companies, all the public companies in the US markets. Wilshire 5000 at that time had 7,500 names. Today, to illustrate your point, that same index is down to less than 5,000 names. I think last I saw 3,700 names, something like that. And so you've definitely seen a shift where companies are staying private for longer. And so if we're missing that opportunity, we're missing a huge opportunity set for clients.
Yeah. So the other thing is, okay, that's great, right? We've got a different asset class that we can access, whether it's private equity, private credit, hedge funds, these different strategies. What is the impact on the portfolio? And so this is just, this is more finance geeking out a little bit, but essentially, we look at what is an efficient portfolio is something that maximizes the return for the risk that you're taking. And the way we measure risk in portfolios is the volatility. How much does it move, right? And so traditional investments have this one efficient frontier, but as we add alternatives and non-traditional assets, it really shifts that efficient curve up. and meaning that we can get the higher potential return for the same level of risk or a potential lower risk and the same level of return, right? So it really allows us to optimize, to use your word again, Matt, the portfolio. And the graphic is illustrating the same thing here, right? These lower pie charts are traditional equities and bonds. As we move up where we're adding some alternatives, right, we see that shift, the risk return profile shift. And if we look at, kind of digging deeper, right, a traditional 60-40 bond portfolio has an annualized return of about 8.7 and a risk metric or volatility of 9.7. Well, if we add some alternatives and take our equities to 40, bonds at 30, and add 30% alternatives, it takes our annualized return up about, 30 basis points or 9.1%. Not a huge shift, but you see a significant drop in the volatility, the fluctuation within the portfolio. So I think that just illustrates the benefits to adding some of these strategies to the portfolio, not only for the return potential, but also we're not going to be subject to wild swings within the portfolio because we're bringing down the volatility within the portfolio by utilizing some of these strategies.
Yeah, I think that's such an important piece to really focus on is, we all love volatility when the market's going up. We get very excited about that, seeing our portfolio grow and grow, but obviously nobody likes it on the way down. And so if we can smooth those ups and downs over time, and I always like to remember too how the math of investing works against you. So if you start with $100 and lose 50%, you now need a 50% return just to get back to even. So we can build wealth faster if we can avoid those major drawdowns as well.
Yeah. And it also, one of the things we've noticed as well is it helps kind of manage the emotions when there is a drawdown in the portfolio, right? I mean, hey, the portfolio is down, get me out. Well, hey, some of these alts, you only have quarterly liquidity or annual liquidity. You really can't get out. So it kind of protects you from your emotions. And what we find is, hey, things recover if we can just kind of stay the course in some cases. These alternatives kind of protect us from those emotional reactions when the market is kind of volatile and bouncing around.
Yeah, absolutely.
So as we think about why personalization, right? And Matt, I think you brought it up when we were talking about why we're accessing some of these strategies is, there now is the opportunity, call it technology, the democratization of investing. There now you should have a portfolio that reflects your values and your risk return expectations. It should be optimized to meet your tax picture. And then, utilizing professional management to optimize that portfolio. I think it's a very competitive space, and you can really get some value for the cost of some of these professionally managed strategies within the portfolio. And so a lot of folks we find, Matt, as they come on with TM Wealth Management, is they bring their portfolios and they've done very well in terms of their savings, but their portfolio is not optimized. It's not meeting their needs. They're not taking advantage of some of the technology and strategies and tax optimization that are available these days because they've just kind of stuck with what they've known for the last 10 plus years.
Yeah, where I really see even going beyond some of the alternative assets and that we've been talking about, that tax optimization is a big one there, where you see people, like you said, headline numbers are showing really strong returns, but if you're taking short-term capital gains, that you're paying at relatively high ordinary income rates, your after-tax return is much lower. And there's certainly some opportunity within the different types of vehicles, the different types of structures here to really optimize around that tax piece, hopefully generate some income for cash flow needs to avoid having to sell as much from the traditional assets and take gains there. So definitely a lot of work in the tax optimization is something that I just don't think enough investment advisors out there focus on.
Yeah, and if you think about it, it's the old saying goes, it's not how much you make, right? It's how much you keep. And so I think the tax piece really is an important element. And some of the personalization opportunities that we've been seeing have an impact on client portfolios, direct indexing, we spend a little bit more time on that. Private equity, both private, companies, but also private debt, right? We're able to get a little bit better return. And then direct investing, right? There was a data center investment we brought to clients and direct investment in a mental health opportunity. So looking for some of these things, not only just through a fund structure, but also direct investment increases that non-correlation and has those kind of risk return elements to the portfolio that help optimize the outcomes for clients.
Yeah, one of the things I would mention here is we're talking about, the private shares fund, just that private equity investment. Some of these companies you hear so much of, like SpaceX, the merger with XAI that Musk has just pushed through. Those companies are not public yet, and we can access those really exciting up and coming opportunities through these direct investments in private equity companies.
Right. So let's talk about specifically one of these, direct indexing. And I think this is, if we can understand it kind of conceptually, then the mechanics of it make a lot more sense. And so most investors access the S&P 500 through a fund, right? Whether it's Vanguard's, VOO or the Spider's SPY, we want to capture the market return by tracking the S&P 500. What is now available for certain clients is to develop your own S&P 500 index, or an index that will track specifically a benchmark of your choosing. And in this case, we're talking about the S&P 500. And so rather than going out and buying a fund, the strategy will go out and buy a basket of securities, individual securities that will track the S&P 500 very closely, in some cases, identically. But that also then allows you to customize your index, right? You might say, you were talking about ESG, Matt. Hey, I don't want any oil and gas in my portfolio, or I'm not supportive of, gun manufacturers, or, what Facebook is doing, whatever, right? You can come in and customize it for what meets your values. And that's this personalization piece. And then when we go to optimize it, right, to be able to follow the S&P 500, we don't need to hold all, and it's actually, I think now at 503 companies is the S&P 500. We don't need to hold all companies, right? We know that the vast majority of the growth or returns in that index are driven by about 150, maybe 200 individual stocks that drive the index. So that's why you see in these kind of pie charts, the full index is the larger pie chart, but to get the actual returns to track that index, we don't need all of the companies, right? So the way that this is illustrated in this graphic here, it's saying, hey, if the index is HCA, Exxon, BP, Pepsi, Coke, and J&J, may be able to get the full return. We just need HCA, BP, and Pepsi. So we structure that index for you, and then we take advantage of daily tax loss harvesting, right? In this case, it might be, hey, Pepsi's down. Let's sell Pepsi because we have it up here in our index, and let's go buy Coke. What that does is it allows us to lock in that loss in Pepsi, but still maintain the same upside opportunity by holding Coca-Cola in your portfolio. At the end of the day, what that allows us to do is take those losses to offset the gains so that the tax efficiency of your strategy is optimized. Does that, anything you want to add there, Matt, in terms of explaining direct indexing?
No, I think you did a good job with the overview there. I just want to say how incredibly efficient that has been for our clients from an overall tax optimization perspective. You look in there, we talk a lot about the tax loss harvesting power, but if you look at a year like last year, we had clients who track the index, so up 15+% last year on their direct indexing portfolio. At the same time, we had clients who harvested 100, 200,000 in losses while making those gains. And so what does that mean? That means we can take gains in other parts of the portfolio. They can have, take long-term gains in retirement with no tax impact whatsoever, because they can take those loss carry forwards and use those to offset the gains. So I just think it's an incredible way that technology has improved our ability to deliver, that tailored solution to clients, specifically designed, as you mentioned, not only to make the portfolio fit them from a values perspective, but deliver a higher after-tax return as well.
Absolutely. And this graphic here kind of illustrates that in a more detailed way. So if you look at this, right, the orange bar here is the S&P 500, what we all know and love, right? The blue line is the direct index, your portfolio that is tracking the S&P 500. You can see it's very similar, right? And this time frame showed that the direct index outperformed, but at the end of the day, we're not trying to get outperformed. We're trying to just perform like the S&P 500. So you figure, started at zero at the end of this year, say you had $1 million in this strategy, you are now have 1.2. This yellow bar illustrates the percentage of the portfolio now that has realized capital gains or realized capital losses. And in most cases, short-term capital losses, which are the most valuable losses because they can offset, ordinary income or long-term capital gains losses as well. So if we look at this at the end of the year, right, you've got 15% of capital losses, the cumulative loss. And so what that means is, yeah, your portfolio is up 1.2, but now you have $150,000 of tax losses that you can offset that $200,000 of gain. So effectively, if you sold at that point, you'd only get taxed on $50,000 of gain because of the tax losses that were able to be accumulated through this specific strategy. And to your point, Matt, we've seen this work now for clients, and it allows you to get the market return, but in a much more tax efficient manner. So again, as we think about this specific strategy in direct indexing, it allows you to personalize it, right? You might have, one of the things we find in the United States with investors who are very home biased, right? We know the United States, we invest in the United States, but as we saw last year, and it's still continuing this year, international markets are outperforming the U.S. market. So maybe you said, hey, I really want international exposure. Let's pick an international benchmark, a global benchmark, or maybe it is the U.S. benchmark. But then you can personalize it, as we talked about, right? Maybe certain companies you don't want in your portfolio. You customize that to you and develop your portfolio. And you also set your tax efficiency, right? We want to know what your tax brackets are so we know what the overall benefit and impact will be to some of these strategies as we're doing that tax loss harvesting. And so really at this stage of the game, it really doesn't there's no reason not to have your portfolio personalized to your specific values, goals, needs, and outcomes. And again, coming back to the word you used at the beginning, Matt, really optimizing all of those things for the client's individual benefit.
Yeah, I think it's a really exciting time from an investing perspective where you have an opportunity to access different types of investments and utilize technology tools to improve those outcomes, get those optimized not only on a tax perspective, but a structure perspective as well.
Yeah, absolutely. And again, just remember, as you're constructing portfolios, kind of our philosophy is we'd rather have more tools than less, and looking at these things and understanding the pros and cons of them and how they might be able to impact your portfolio to help optimize the outcomes that you want to have, both from a income and return and risk perspective, to utilize those in constructing your portfolio. So, Matt, it's been a great conversation. I think we've highlighted some things that investors and folks should be really thinking about. And I enjoy doing these kind of presentations, but we really want to say, okay, well, what do we do now, right? And I think the first thing we would point to you is feel free to reach out to us, right? Our goal is to really be helpful and really help you apply these general principles to your unique situation. In addition, we've got a number of resources, right? We've got an alternatives white paper, estate planning, tax planning, whatever it might be, to be able to meet the needs and apply these things specifically to you. And then lastly, feel free to sign up for we've got a ton of content, our weekly market update. We've got social media posts we do on a regular basis, and reach out to us to schedule a call. At the end of the day, we like to be helpful and point people in the right direction to make good financial decisions, and we hope you'll reach out to us. With that, Matt, any last thoughts or comments as we think about kind of portfolio customization?
No, I think you summed it up nicely. As you said, I think we have a lot of expertise, and it's a lot. And I personally, really enjoy sitting down with clients and talking to them about these opportunities, seeing what is the right fit. And I think that personal touch that we bring here at TM Wealth is so important. And you talked about that as we started in terms of why you structured the business as you did. It's because you love working with individual people. We all do. We don't want to be that call center. We want to sit down and give you those customized solutions for you.
Right. Well, we hope you'll reach out to us. Hope this has been helpful. If you have any specific questions, feel free to reach out to us. Send us an email, give us a call. We really want to be helpful and help you apply these principles to your unique situation. With that, have a great rest of your day. Look out for more of our content and webinars, and we hope you'll join us in the future.